Hi, ladies and gentlemen. This is Shelley Kraft coming to you live on SNN Live. We're coming to you from the LD Micro Invitational 2015 in Bel Air, California. I have with me David Weild IV from Weild Company. It's a private company. David, welcome back to SNN Live.
Thanks, Shelley. Nice to see you.
It's good to have you. Yeah. Let's get an overview on Weild Company. I like Weild Co.
Yeah. Well, we set up an investment bank securities firm to do everything that Wall Street wasn't doing for corporate clients. So we've eliminated all the conflicts. We don't take commissions from investors. We discovered that 60 institutions are generating about 90% of the commissions to most Wall Street firms, yet they need to typically reach out to probably 250 institutions. So we have a totally different distribution model. We use data science and technology and Series 7 registered professionals to systematically broaden distribution. So we think we can double, triple demand on most equity offerings, quality demand, and that the buyers that we bring to the table are typically better buyers in the aftermarket. So that's what we're doing.
How do you make money?
We make money from deal fees as part of the gross spread on an underwritten transaction, retainer fees from corporate issuers, and we also help them navigate and do a better job of putting together management groups on Wall Street using our data science and you may not know this, but I ran equity capital markets at one of the major bracket Wall Street firms. So we have a number of people like that really understand where all the bodies are buried on Wall Street, and we can help companies do a much better job of navigating that.
So what's going on the street?
Well, in Washington, there's a lot of discussion right now about the tick size pilot, which is an idea that we actually initiated at a dinner for the then Vice Chairman of the House Subcommittee on Capital Markets. And then the other thing, which I think is an outgrowth of a 2011 op-ed that I wrote that was published in the Wall Street Journal, which would create a systematic fix for small cap companies, is this idea of creating a venture exchange, which is a new construct under the 34 Act Stock Exchange of 1934 that would eliminate a lot of the basic requirements that have caused the collapse in support for microcap and nanocap issuers. And so we think that if we can basically start with a clean piece of paper and create new stock exchanges that are optimized around the needs for small cap companies, we can get America back into business. We think that the implosion that occurred when we went to penny tick sizes and low-cost markets dropped the bottom out of the infrastructure that was required to support small companies, and it left probably 10 million jobs on the table for the economy. We published, I mean, you know this, Shelley, but we published data that said that we were doing 500 initial public offerings in the United States in the 5 years before the dot-com bubble. And after these market structure changes occurred, we went to electronic, high-frequency, low-cost trading markets. We dropped to 150 IPOs a year. On a bigger economy, we should be doing 950. So the difference a year. So the difference between the 150 that we're doing and 950, of course, is 800 IPOs. That's worth 10 million jobs over a decade, and that's what we want to get back for the country, and maybe tilt the whole trajectory of GDP growth up a little bit, take employment absorption rates up. I mean, it's actually a real crisis for poor people in this country, because many times the poor people are the least educated, least skilled, and you need high employment, really high employment and labor participation rates to give those people some hope and get them off the bench and back into the economy. And so this is our way of hopefully contributing a bit to an improved American dream.
Let me ask you a question. With the drop in IPOs, wasn't that really made up in APOs? Because there's definitely been growth in alternative public offerings. It may not be the traditional IPO, but in one way or another, wouldn't you say there's still capital formation using some other form other than the S1 IPO filing?
Well, there's no question that alternative public offerings picked up slack, but we think that, remember I just mentioned that it's about 800 delta. It's probably worth about 60 deals a year. It's not big. It's really small amounts of capital. So when you look at aggregate impact to the U.S. economy, it's not a big number. There's a better a better metric, because there's a lot of urban legends out there that you're speaking to. One is that venture capital is replaced. Well, it's really late stage. One is that private equity has replaced, it's grown. It's actually not really contributing to startup capital at all in the US economy. The key metric is something that was actually exposed by economist Robert Lighton at the Brookings Institute pretty recently, which is what percentage of companies are startups in the US economy today versus, say, back in 1978. In the late 70s, 15% of all companies in the United States were 1 year or less in age. That's how he defines a startup. That's dropped from 15% down to 8% today. Okay, that's Armageddon. That is horrible for our long-term economic outlook as a nation. That's the kind of stuff that Congress and the Securities and Exchange Commission really needs to address. That is,
isn't that pinned on the angel market? Isn't that pinned on the venture capital market more than it is on the, capital markets in general?
Well, no.
And subsequently, exit strategy.
Well, they're related. It's pretty simple because, to your point, it is the exit strategy that matters, right? Which is the sense that if you now have to be 8 years of age to get a company public, as opposed to 4 years, which used to be the old norm, okay, then by definition, your cost of capital goes through the roof. Fewer companies are getting public, and as a consequence, there's less money that's getting freed up to reinvest in early stage companies. So venture capitalists are very bright people, and they may not understand what's causing the exit problems, but they know that there's an exit problem, so they start to go and invest progressively in later stage companies. So more money chases fewer ideas, which is exactly, remember all the discussion in the Wall Street Journal about unicorns and the Uber valuations and whether or not there's a bubble. That's actually a very narrow part of the US economy that's not going to get America back into business. We need to kind of spread the investment dollars, and once we do that and start taking the level of activity up across the board, we'll be in much better shape.
So for more information on anything this man has to say, I want to send you right to his website, and that website is?
It's weildco.com, WEILDCO.com.
Ladies and gentlemen, David Weild IV, Weild Co. It's a private company. I'm Shelley Kraft. This is SNN Live, and we're coming to you live from LD Micro Invitational 2015, Bel Air, California. David.
Shelley, nice to see you.
Always a pleasure.
Yeah, my pleasure.
Good to see you.
Good to see you.